Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and looks like we have quite a bit to cover here. Markets are about to open a little higher than where we closed yesterday. So let's take a look at some of the research. Let's take a look at where the markets currently stand. Now, before I get started, just a quick disclaimer. What we're going to discuss here today is purely for education and not a solicitation to buy or sell any specific securities. Now, if we take a look at the current market outlook, this is something we've discussed every single week for those of you that have been coming to our Tuesday morning sessions. Obviously, after the big sell-off, we've had a fairly strong retracement, and we've said 284 was a major resistance level for this market, and that was the level that the markets have struggled with historically over the past week to get above that 284. But yesterday, we really managed to push above it, and looks like today we're about to open up a little bit higher. So we certainly have continued to push higher, or grind higher rather. But I do want to point out some of the things that I think are worth noting, because at this point, the directional view of the S&P 500 is pretty clear. Ever since we managed to test that 242 support level, we've pushed back up to that 284, struggled a little bit, but started to push higher now. So the directional view is very strong and very clear. However, some of the things that I do want to point out is that as the market has rallied from this 242 to 280, 290, as we're about to open up at 291 right now, one of the things that you want to keep a mind of is that, first of all, volume has continued to decline as we continue to push higher and higher. Granted, this volume is still higher than normal previous to the sell-off, but this the fact that volume has continued to decline as the markets rally is showing us that's a sign of some type of exhaustion here in the market. Now, markets can remain exhausted for quite some time and continue to grind higher, and that's really the thing to remember here, that just because we're seeing signs of exhaustion does not necessarily mean that a pullback here is imminent, and the pullback that we do eventually get as a result of this exhaustion may be relatively small. It doesn't necessarily have to lead into a very big sell-off here, but we want to take a look at some of the data to show you what we're currently looking at. So first of all, we broke above that 284 level, so this certainly puts us, again, in a very positive state in terms of the market. Some of the things that we discussed last Tuesday, such as the VIX contango, VIX is back in contango, so the front month VIX is now below the 3-month VIX, giving us more of a risk-on environment to be in. There certainly are signs of exhaustion. I'll show you some of those signs of exhaustion that we're currently looking at. But small caps have joined this rally. So small caps have been doing quite well. Yesterday, it looks like it's about to open up about 3% higher again today. Generally speaking, small caps have been lagging behind the overall market. So that was something that was surprising to us to see that. One of the concerns that we still have with this current market rally is really just oil. Oil continues to grind lower. And this really speaks to the devastation of the economic impact globally we currently see. In my opinion, that actually tells us more than what the current equity markets are currently telling us, because right now we're seeing more and more narrow leadership in the equity markets, meaning fewer and fewer stocks, very, very large cap stocks are dragging this market higher, while there's still a large number of stocks in the S&P 500 that have not recovered to these types of levels. But because the top 5 companies make up 22, 23% of the index, they're dragging the entire index higher. So, some of the sectors to pay attention to here are tech, healthcare, and communications. These are some of the sectors that are starting to see these signs of exhaustion. If you're being opportunistic and you're looking for shorts, these are the sectors that I would pay attention to right now in terms of trying to find opportunities of exhaustion. While you have some of the oversold sectors such as financials, industrials, and utilities showing much healthier looking charts. So if you're still trying to pick some bottoms, if you missed out on this rally and you're looking to find some stocks that you want to purchase, I would focus my attention in some of those particular sectors. It's certainly a big week here for earnings. We have some big names reporting, so we'll go over some of those charts here as well. So the oil market is really the one that I'm paying attention to heavily right now, both WTI revisiting that $11 price level for the June futures, Brent also making a brand new low down to $19. So Brent looking particularly weak here. Crude continues, WTI continues to move lower. This speaks to the lack of demand that the world currently has for oil. This speaks to the number of global economies that are currently shut down that do not need as much oil as we used to, and we continue to pump a significant amount of oil out of the ground that simply, there's nowhere for it to go, and that's why these oil futures are collapsing. Again, for me, this speaks volumes as to where we currently sit from an economic perspective that is drastically disconnected from where the equity markets are going and currently trading. Basically less than 15% away from the peak that we had here in February 2019. February 2020. And obviously, we live in a very different world than where we were in February, in the beginning of February. Now, one of the things that I want to point out here is that this rally that we're currently in has seen very little leadership. Has seen very narrow leadership, because normally with a rally up here, we've had more than a month of a rally. The low here is on March 23rd. We are now on April 28th. So we're looking at more than a month off the bottom of that low. But if you look at the number of stocks above the 200-day moving average, it's only at 22%. That is historically very low. And I put this chart here just so you guys can see. This was the December 2018 sell-off. So many of you still remember the December 2018 sell-off, where we reached a low of about 10% of stocks above the 200-day moving average. But as the markets rallied, this indicator came back pretty much back into the 50 level very, very quickly. Here, we're seeing this move much, much slower. And we're still at 22% of overall stocks are above their 200-day moving average. That means 75% of stocks in the S&P 500 are still trading below its 200-day moving average. Now, this type of narrow leadership shows us that this type of rally is likely going to be reversed lower. Now, what this chart doesn't tell us as far as how far can this market continues to move higher before it moves lower. And just because it moves lower, it doesn't necessarily mean that it's going to pull all the way back to 240. It could pull back, let's say, just to 270, 260. But this is telling us that this short-term rally is, in the short run, perhaps coming to an end, and there's going to be some sign of a reversal. Now, what this doesn't tell us is when it's going to reverse and how big of a reversal we'll actually get. But these are some of the signs that is discouraging, if you will, of continuing to add on to long positions as the markets continue to move higher. From my perspective, I would be more inclined to fade these higher moves as the market continues to move higher. So small caps joining in the rally here. Breaking up about IWM, I think, was up about 3% yesterday. 4% yesterday, is up about 3% pre-market today. So we're certainly starting to see small caps join the rally. That is a good thing. That's a healthy thing for the market. If small caps were not joining this rally, I would have even a slightly more bearish view on the markets, especially as we continue to rally. But if small caps are joining in on this rally, that certainly is supportive of this S&P 500 rally, so that is an encouraging sign for the markets as they continue to improve. I want to take a look at some of the sectors. So, the S&P, as I said, the S&P 500 has continued to move higher. They're starting to see signs of exhaustion here as the market continues to push higher. We're opening up at 291. But if you look at some of the sectors like consumer discretionary, now the thing about consumer discretionary, XLY, is that 40% of the index is made up of just two stocks, Amazon and Home Depot. Amazon has at this point been pretty much range bound between this 2,300, 2,500 level. Yesterday it did have a bit of a, yesterday it was down 1.5% when the markets were up about 1.5%. So this starting to see some dislocation here in Amazon with the broader market. Home Depot just trading above that, just trading right below the 200-day moving average, is not opening up any higher despite the markets pre-market are up about 1%. So definitely starting to see some signs of exhaustion here in XLY. especially as it continues to make higher highs. Momentum is not making higher highs. This is a sign of exhaustion here. So be careful getting into consumer discretionary, which looks like it has a lot of strength right now. But my concern is that there's going to be some check back here, perhaps small check back, maybe just down to 108 or so, but certainly seeing some of those signs of exhaustion. Healthcare, the strongest sector that we have in the market right now. We've had a hell of a rally here. If we look at, how big of this rally has this been, this sector is up almost 40% in that last month or so. So healthcare is the strongest sector right now, also starting to see signs of exhaustion as it continues to push higher here, higher highs. It's actually making higher lows on momentum. So be careful stepping into XLV, the healthcare sector. And lastly, technology. Technology putting in a bit of a double top here. And again, even though the market is making a relatively similar high, momentum continues to decline. So those are some of the sectors that I'd be very careful about going long, even though these are some of the strongest sectors: discretionary, healthcare, and technology. Vice versa, on the flip side, financials. Financials really starting to come to life here, up 3.5% yesterday. Start opening up fairly flat here, but if you look at some of the names like JPM is about to open up another 3% higher. So especially some of the names that have stronger balance sheets like JPM, Bank of America, Citigroup, those are some of the names that have really started to take to life over the last few trading sessions. So if you're looking for long opportunities, you might want to look at some of the weaker sectors such as financials. Even industrials have been doing quite well. Industrials up 2.5% yesterday. It looks like it's opening up flat here, but industrials really putting in a pretty strong resistance level here around the $64 level or so. I would look for a break here to see if it continues to move higher. That would be a signal that industrials is starting to rotate higher, while perhaps consumer, healthcare, and technology perhaps starts to roll over a little bit. So we're certainly seeing some sector rotation here, unlike a few weeks ago when markets were pretty much trading in lockstep and all sectors either moving higher and all sectors moving lower. But the past few weeks, we're continuing to see this type of bifurcation, not only within individual sectors, but across the entire market. Some sector rotation currently going on. So those are some of the top trends that we're currently seeing in the overall market. One thing I do want to point out is Twitter. Twitter reports earnings this week, and similar to Snapchat from last week, and this is just the earnings calendar. We're going to come back here to in a minute here, but Twitter reports here on Thursday. We obviously have Apple on Thursday as well, which is a big name. We'll come back to this earnings calendar here in a few minutes, but I wanted to take a look at Twitter because I think Twitter has the potential to follow in very similar footsteps to Snapchat. Snapchat, for those of you that follow this, is one of the earlier reporters of the social media plays, if you will, that rely on revenue. There's pretty much four main players here in this particular space: Snapchat, Twitter, Facebook, and Google. Snapchat obviously being the smallest, Twitter being the second smallest, Facebook being third, and Google being the gorilla here in the room. So Snapchat gave us a pretty good preview into how advertising revenue, how usage of social media platforms look like during the coronavirus. And I think Twitter is certainly one of the platforms that many people rely on for information, especially real-time information these days. So Twitter, I think, can potentially have follow in the same footsteps as Snapchat. The thing to keep in mind, the stock has rallied almost roughly 20% over the last few trading sessions, so there may be limited gains here, but the fact that it broke out above this $30 major resistance level is certainly a strong indication here for this particular platform. The stock is not as strong as Facebook and Google. Facebook definitely just got rejected yesterday at the 200-day moving average. Looks like it's about to retest that today. Google, very similar chart here, really struggling with that 200-day moving average. So again, this is what I was showing you before, how many of these major stocks are still trading below their 200-day moving average, despite the market still approaching, starting to approach that 200-day moving average, at 300. My expectation here is that there is the possibility that markets grind their way higher up to that 300 level before it starts to roll over. But, again, leadership here is still very narrow here. 22% of stocks above its 200-day moving average, 44% above the 50-day moving average, 86% above the 20-day moving average. That is particularly high, the 20-day moving average. But, as markets continue to move higher, that actually continue to move lower. That's some of the divergence that we typically look at for signs of exhaustion here on individual stocks. So Twitter is one that I'm keeping my eye out here for this week, especially after breaking above 30 yesterday. Breaking above that 29 resistance level yesterday and starting to move higher. That's definitely one of the stocks that's on my radar. Another stock that's on my radar is Netflix. So, as many of us are watching the news and we're looking at our stocks coming back to, are we going to reopen up our economy? How soon are we going to reopen up our economy? What is that going to look like? This is a communication stock. This is one of the sectors that also have seen some signs of exhaustion. But just from a very basic technical analysis chart pattern perspective, this is the daily chart. As you can see, there's been a lot of congestion here between 220 and 240. This is the hourly chart. And if you look at the hourly chart, it's a pretty clear triangle here where you have basically a 420 support that continues to get tested here multiple times. And then you have this resistance level that continues to get tested and it continues to make lower lows. So this has two ways to go. It either can move, break out to the upside or break out to the downside. And you have a fair amount of opportunity on either way. So if you get a breakout to the upside, you could retest that 450 high. That gives you about a 20%, a $20 move to the upside. Break to the downside gets you right back to that 380 level. It's about a $40 bet to the downside. If we look at momentum, there are some concerns here. As we hit higher highs, momentum cannot make a higher high. And as this continues to go, as you can see, momentum remains very, very weak and has the potential of breaking to the downside. Now, hasn't broken out one way or another yet, but if we do manage to get a significant break below 420, then this could bring us back into that 380 level. And we're starting to see signs of exhaustion like that for a lot of these types of COVID streaming stocks, if you will. Everything from gaming stocks like Electronic Arts. As Electronic Arts continue to make higher highs here, the momentum continues to make higher lows. And, this is the first time, in a pretty long time as EA continued to move higher, and continue to make higher highs and higher lows, that you started to see this lower high and momentum is really starting to slow down. So this shows me that there's a higher possibility of a pullback here. It still can move higher, but certainly a higher probability of a move lower here. And as you can see, on yesterday's 1.5% move higher, EA did not move any higher. Looks like it's opening up flat here while markets are opening up another 1% higher. So a lot of these streaming stocks starting to see signs of exhaustion because, again, as we start to plan on reopening our economy, these stocks likely are going to underperform during the time of reopening because I'm guessing that people are going to want to get out of their house because we've been stuck indoors for so long. People are going to take that opportunity to do things perhaps that they wanted to do outside of the house, whether it's go to a restaurant, and spend less time in front of screens because I think we all have spent enough time in front of our screens for the last 5 or 6 weeks. So those are some of the trends that we're paying attention to as we reopen our economy. Looking at travel data is starting to look a little better, but airline stocks continue to underperform. But we have noticed a significant kind of support level on most of these travel stocks because travel has pretty much bottomed at this point. If we look at international travel, we actually saw the first uptick in international travel last week. That, again, does not mean that we're going to see a liftoff in any of these stocks, in my opinion, soon, but that does, in my opinion, feel that we are starting to put in a bottom here for many of these types of airline stocks, whether you're looking at Delta, American. The only one that I don't follow as much are some of the domestic airlines, but if we look at domestic airlines like Southwest, actually still looking pretty weak here. International airlines looking a little stronger here. So, from a relative strength perspective, I certainly would prefer the international airlines versus more of the domestic airlines at this point. Boeing also reports earnings this week. Boeing has seen a significant amount of weakness this week as markets continue to rally. Boeing has continued to push lower here. This past week, it's actually continued to make new lows. We have a support level here around 120. That's a major one that we're keeping an eye out for. Boeing reports, I believe, on Wednesday. So tomorrow we have Caterpillar, we have Google, Starbucks, Pfizer, Pepsi. Those are just the big names to pay attention to, especially in the consumer space. GE, Facebook, Microsoft, MasterCard, Boeing. Those are the big names tomorrow. And then obviously Apple, McDonald's, Twitter, Visa, Amazon the day after. So big names in the calendar this week. Next week is a little lighter. But this week is really the big week that we're really paying attention to for earnings. And I think that can make or break this particular rally that we're currently in right now. So pay attention this particular week. Make sure that you know which names are coming up in terms of earnings. Really important to stay on top of those things for your trading. So with that, that's the market outlook here for today. That's the data sets that we're currently paying attention to. Those are the sectors and names that we have highlighted in our research. Again, I hope that you guys are staying safe and staying well. And please, if you have the opportunity of getting outside, take the opportunity to get a breath of fresh air. Hopefully we'll be out of this soon and we'll be able to get back to our normal lives. And I hope that you guys all take away from this, something beyond just, resuming our normal lives, because this has changed the way we work. This has changed the way that we access things. And I really hope that we take something good out of all of this. So thank you so much. I hope you guys have a great trading day, and I'll see you guys next week.